Disclaimer, 40.23. That's the Schiller PE ratio right now, January 2026. You know what? The only time in history it was higher was 1999, right before the dot-com crash wiped out 80% of the NASDAQ. And here's what should terrify you. The conditions building in 2026 aren't just similar to 2008. They are worse. In 2008, we had one crisis, real estate. In 2026, we have 4 crises converging simultaneously. And today, I'm going to show you exactly what they are, when they will hit, and what happens to your money when they do. Most economists are predicting no recession in 2026. Deutsche Bank says 1.4% growth. Morgan Stanley says moderate expansion. JP Morgan puts recession probability at 35%. Sounds manageable, right? These are the same institutions that in 2007 said subprime was contained. The same experts who in 2000 said the new economy had eliminated recessions. The same forecasters who have been wrong at every major turning point in financial history because their models don't account for what happens when multiple systems break at the same time. Let's break down the 4 crises converging in 2026. Once you see how they connect, you'll understand why this isn't fear-mongering. This is mathematics. This is systemic risk. And yes, it's real. Crisis 1, commercial real estate collapse, $936 billion. That's how much commercial real estate debt matures in 2026 alone. Another $525 billion matured in 2025. Combined, that is nearly $1.5 trillion in loans that need refinancing at interest rates roughly double what borrowers originally paid. Here's the math. A building financed in 2021 at 3% now needs refinancing at 6% or higher. That doubles the debt service payment. But the value of these properties has dropped because office vacancy rates have exploded to 20% nationally. Some markets, like San Francisco, are approaching 30%. Austin hit record highs. So the borrower faces an impossible situation. They owe more than the building is worth. The payment has doubled and they can't sell because nobody's buying. What do? They hand the keys back to the bank. This isn't theoretical. We're already seeing this. CMBS delinquency rates hit 6.59% in the third quarter of 2025. For office properties specifically, the distress rate reached 10.9% in October, up from 6.7% just 2 years ago. 278 banks have been identified as vulnerable due to concentrated commercial real estate exposure. Over 900 banks still carry CRA exposure above 300% of their capital. In 2008, the problem was residential mortgages. Banks had loaded up on subprime home loans that went bad. Today, the problem is commercial mortgages. Banks have loaded up on office buildings, retail centers, and multifamily properties that are going bad. Same mechanism, different asset class. In 2008, the banking system absorbed roughly $400 billion in losses. In this cycle, commercial real estate losses could exceed that number easily. Crisis 2, the stock market bubble. The Schiller PE ratio at 40 is the second highest reading in 140 years of data. The only time it was higher was December 1999 at 44.19. You know what happened next? The S&P 500 fell 50%. The NASDAQ fell 78%. The Buffett indicator, which compares total stock market capitalization to GDP, is 225%. The historical average is 100%. Anything above 160% is considered significantly overvalued. Warren Buffett himself said that ratios approaching 200% mean investors are playing with fire. We're at 225, and here's the concentration risk. 7 stocks, the so-called Magnificent Seven, now represent over 30% of the S&P 500's total market capitalization. Apple, Microsoft, Amazon, Alphabet, Meta, Nvidia, Tesla. If these 7 stocks correct, the entire market follows. This isn't diversification. This is concentration masquerading as an index. The AI boom driving these valuations mirrors the internet boom of the late 90s. Revolutionary technology, real productivity gains, massive investment, parabolic stock prices, followed by a crash that wipes out trillions in paper wealth. The question isn't whether AI is real. The internet was real too. The question is whether current prices reflect reality or fantasy. At 40 times cyclically adjusted earnings, fantasy is winning. When KP ratios exceed 30 for extended periods, markets have always experienced corrections of 20% or more. At 40, we aren't pricing in growth, we're pricing in perfection. And perfection doesn't exist. Crisis 3, the debt doom loop. $38 trillion, that's the current national debt as of this month. It was $36 trillion at the start of 2020. We'd be adding roughly $2 trillion per year in new debt. But here's the number that matters, $1 trillion. That R is S, what the federal government paid in interest on the debt in fiscal year 2025. Interest payments are now the second largest line item in the federal budget, behind only Social Security, larger than Medicare, larger than defense. The Congressional Budget Office projects interest payments will hit $1.8 trillion annually by 2035. But that projection assumes interest rates decline. What if they don't? What if they rise? Every 1% increase in average rates adds roughly $380 billion in annual interest expense. The debt doom loop works like this. High debt requires high borrowing. High borrowing puts upward pressure on interest rates. Higher rates increase interest expense. Higher interest expense increases the deficit. Higher deficits require more borrowing. The cycle feeds on itself until something breaks. In 2026, the federal government will spend roughly $1 trillion just paying interest. And that's $1 trillion that doesn't build roads, doesn't fund schools, doesn't strengthen defense, just services previous borrowing. And here's what makes 2026 dangerous. The debt ceiling was reinstated in January 2025 at $36.1 trillion. We've already blown past it. Another debt ceiling showdown is coming. Another credit rating downgrade is possible. Moody's already cut the U.S. from its highest rating in May 2025. We're running out of runway. The 2008 crisis was triggered by private sector debt, mortgages, credit cards, corporate borrowing. The next crisis will be triggered by sovereign debt, government borrowing. That's harder to fix because the entity that normally does the fixing is the one that's broken. Crisis 4, the consumer breaking point. $1.66 trillion in auto loan debt. Average payment of $748 per month. Subprime auto delinquencies at 6.65%, the highest since tracking began in 1994. 1.73 million vehicles repossessed in 2024, the highest since 2009. 28% of trade-ins are underwater, meaning people owe more than their cars are worth. Here is the indicator that terrifies economists. Car loans are typically the last payment Americans skip before the mortgage, before credit cards. The car payment comes first because you need the car to get to work. When car loan delinquencies spike, it means consumers have exhausted every other option. They've cut spending. They've maxed credit cards. They've depleted savings. They're at the end. Subprime borrowers aren't marginal. They're the canary in the coal mine. Now, let me show you how these 4 crises connect, because individually, any one of them could be contained. But together, they create feedback loops that amplify each other. Commercial real estate losses hit banks. Banks tighten lending across all categories. Tighter lending slows the economy. Slower economy increases unemployment. Higher unemployment means more consumer defaults. More defaults mean more bank losses. The cycle accelerates. Simultaneously, if stocks correct 20 to 30%, the wealth effect reverses. Consumers who felt rich because their 401k was up suddenly feel poor. They cut spending. Business revenues drop. Corporate earnings fall. More layoffs, more defaults. The stock decline becomes self-fulfilling. Through it all, the federal government can't stimulate like it did in 2008. In 2020, it was running $2 trillion deficits at full employment. Interest payments already consume $1 trillion. There's no fiscal space left. The Fed can't cut rates to 0 again because inflation isn't dead, still above 2%. The Fed is trapped between fighting inflation and preventing recession. In 2008, we had 1 crisis and unlimited policy ammunition. In 2026, we have 4 crises and no ammunition left. That's why 2026 could be worse than 2008. Now that you understand the 4 crises converging in 2026, the next question is, what happens next? And how do you prepare? Because the story doesn't end with the warning signs. The story ends with the choices you make before the next collapse hits. Let's start with the objections that experts always raise, because they're predictable. First, the economy is resilient. GDP growth is positive. Unemployment is low. But let's look back. GDP was positive in 2007. Unemployment was low in 2007. Stocks were at all-time highs in October 2007. The economy looked fine, until it didn't. Recessions are only visible in hindsight. By the time data confirms a recession, you are already 6 months into it. The indicators I've shown you are forward-looking. They're telling you what's coming, not what's already here. Second objection. Banks are stronger now. They have more capital. Regulations are tighter. True, banks have more capital for the risks regulators anticipated, but they don't have capital for concentrated commercial real estate exposure at this scale. 900 banks with CRA exposure above 300% of capital, 278 banks already identified as vulnerable. The regulatory framework is always designed for the last crisis, never the next. The next crisis always finds the gap. Third objection. The Fed will save us. They'll cut rates. They'll print money. The Fed's balance sheet peaked at nearly $9 trillion. They're trying to shrink it. Inflation remains above target. Cutting rates aggressively risks reigniting inflation. Printing money when debt to GDP is already 120% risks a currency crisis. The Fed's tools are designed for deflationary recessions. What happens when the crisis is inflationary? What happens when rates can't go to 0 because inflation won't let them? We're about to find out. Fourth objection. This time is different. AI will drive productivity gains. Technology will save us. The internet was going to save us in 2000. Real technology, real productivity gains. Stocks still crashed 78%. Technology was real. Valuations weren't. AI is real. Nvidia's revenue growth is real. But when CAPE hits 40, when the Buffett indicator hits 2 and 25, you're not paying for technology. You're paying for a story. And stories don't have earnings. Eventually, reality intrudes. So what do? Let's break it down into 6 steps to survive 2026. Step 1. Stress test your portfolio for a 30 to 40% drawdown. If you can't stomach that loss, reduce exposure now, not after it happens. Many investors assume that markets will behave like they did in 2023 or 2024. They won't. Historical data shows that when CAPE ratios exceed 30 for long periods, markets correct sharply. At 40, the 30-40% drawdown is almost guaranteed. Prepare mentally and financially. Step 2, build cash reserves. 6 to 12 months of expenses is minimum. In a credit crunch, liquidity is king. Look back to 2008-2009. Those with cash were able to buy assets at generational lows. Cash is optionality. It's power. It gives you flexibility when others are forced to sell. Step 3, reduce exposure to rate-sensitive assets. Long-duration bonds, highly leveraged companies, commercial real estate. These are the assets that break when rates stay higher for longer. Refinancing costs double. Debt loads overwhelm earnings. And when one lever breaks, it creates domino effects across portfolios. Step 4, diversify geographically. International markets are trading at significant discounts to U.S. markets. The Schiller PE for international developed markets is roughly half the U.S. level. When the U.S. corrects, capital flows elsewhere. Diversifying internationally provides both protection and opportunity. Step 5, own hard assets. Gold hit record highs in 2025 for a reason. Central banks are buying at the fastest pace in decades. They're diversifying out of dollar assets. Physical assets like gold, silver, and real estate can act as insurance when financial assets are stressed. In past crises, 1929, 2008, those who held real assets preserved capital better than those in paper assets. Step 6, pay attention to signals. Watch CMBS delinquency rates. Watch auto loan delinquencies. Watch the yield curve. Watch bank earnings. When these deteriorate faster than expected, the timeline accelerates. Early warning signs aren't speculation. They are observable, measurable data. They tell you when the match is about to be struck. The mainstream forecast is for a soft landing, mild slowdown, no recession. That's the base case, but base cases assume nothing goes wrong. Right now, 4 major systems are flashing warning signs simultaneously. Commercial real estate, $936 billion maturing in 2026. Banks exposed, values falling. Stock market, Schiller PE at 40, Buffett indicator at 225, concentration in 7 stocks. Government debt, $38 trillion total, $1 trillion in annual interest, debt ceiling drama ahead, consumer stress, record auto delinquencies, record negative equity, record repossessions. Any one of these could be a trigger. Together, they create conditions for something worse than 2008. Not because any single crisis is larger, but because the system has no shock absorbers left. 2008 had a crisis and a response. Massive fiscal stimulus, zero interest rates, quantitative easing, bank bailouts, every tool deployed. 2026 will have a crisis and constrained responses. High debt limits, fiscal stimulus, elevated inflation limits rate cuts, political dysfunction limits coordinated action. The tools are duller, the problems are sharper. Here's the uncomfortable truth. Nobody knows exactly when this breaks. Could be first quarter 2026, could be late 2026, could even spill into 2027. Timing is uncertain, direction is not. You cannot run a Schiller PE of 40, Buffett indicator of 225, $1 trillion in annual interest payments, 20% office vacancy, and record consumer delinquencies indefinitely. Something will give. The historical pattern is clear. Every major financial crisis follows the same sequence. Excess, euphoria, exhaustion, collapse, reset. 1873, 1929, 2000, 2008. The names change, the assets change, the pattern doesn't. In the 1870s, excess was railroad speculation. In the 1920s, stocks on margin. In 2000, internet companies with no earnings. In 2008, mortgage-backed securities with fake ratings. In 2026, AI stocks at 40x earnings, commercial real estate refinancing at double rates, government debt approaching $40 trillion. Consumers maxed out on everything. Euphoria is always the same. This time is different. Technology changes everything. Smart people in charge, new paradigm. Then exhaustion, the first cracks appear. Subprime goes bad. Lender fails. Delinquencies tick up. Experts say it's contained, isolated, then collapse. What was contained suddenly isn't. What was isolated becomes interconnected. Fire spreads. reset. Prices fall to levels that make sense again. Assets transfer from weak hands to strong hands. The cycle begins anew. We are in late euphoria, early exhaustion right now. CMBS delinquencies, auto loan defaults, bank vulnerabilities. Cracks are appearing. Experts still say contained, isolated. This time is different. The pattern says otherwise. The pattern is never different, only the names change. Let's talk numbers again. Lehman Brothers collapsed September 15th, 2008, but warning signs started in 2006. 2 years of warning. 2 years most people ignored because the experts said contained. Warning signs for 2026 started in 2023. Commercial real estate stress, consumer delinquencies, bank earnings pressure. We're 2 years into the warning phase. The question is, how much longer until the next Lehman moment? Could be first quarter 2026, could be late 2026, could spill into 2027. The exact date doesn't matter. The conditions exist. The fuel is stacked. The kindling is dry. All that's missing is the match. And in financial markets, matches always appear eventually. The prudent response isn't panic, it's preparation. You don't need to time the exact moment of crisis. You need to be positioned so that when it arrives, you're not destroyed. You're ready to take advantage. Cash provides optionality. Low debt provides flexibility. Diversification provides protection. Hard assets provide insurance. These aren't predictions, they're preparations. Now let's look at historical lessons. In 2008, the S&P 500 fell nearly 57%. Gold rose 5 to 10% in real terms. Cash allowed investors to buy depressed assets at generational lows. Housing markets collapsed 30 to 40% in many regions. But those who had cash could buy at a discount and prosper during the recovery. Treasuries initially provided a safe haven, but yields were near zero after the crisis. Those who relied solely on bonds lost purchasing power to inflation later. The same lessons apply in 2026, but with higher stakes. Debt is higher, interest rates are higher, vulnerability is more concentrated. Preparation is no longer optional. It's survival and opportunity. In conclusion, the 4 crises, commercial real estate collapse, stock market bubble, sovereign debt doom loop, and consumer stress, are converging. Individually manageable. Together, potentially catastrophic. Historical patterns suggest we are entering a phase of exhaustion that precedes collapse. The timeline may accelerate, and the first signs will appear before the headlines confirm it. The warning signs are already flashing, and the people who prepared for 2008 before it happened were the ones who prospered after. The choice is yours. Believe the experts who say soft landing, or believe the data showing Schiller PE at 40, CMBS delinquencies at 7%, auto defaults at 30-year highs, and $1 trillion in annual interest payments. History doesn't repeat, but it rhymes. And right now, the rhyme sounds an awful lot like 2007. The next video will show exactly which asset classes protected wealth during 2008, which destroyed it, and how to apply those lessons to your portfolio before 2026 plays out. Subscribe now to stay informed, because the bill for 20 years of easy money is coming due. 2026 is the year the check arrives. Will you be ready to pay it, or will it be paid with your wealth? Don't be caught unprepared.